Good morning to you. We were just speaking to Jonathan Golub at Credit Suisse and telling us, the traders should sell chips in a slowing economy. But of course, we talked to the CEOs and longer-term investors who say that this could be a really great opportunity because of the secular shift and the rise of IoT.
Yeah, definitely. I mean, I think the buy-side sentiment, the investor sentiment, is far more negative than the sell side estimates. And I think a lot of the investors I've spoken to are expecting some sort of impact with respect to either inflation affecting consumer demand, and that kind of spilling over to some of the secular growth markets like data center or cloud or high performance computing. So there is a kind of a disconnect between what the companies are saying and the outlooks they're providing, which are pretty much been beat and raise quarters, and what the sell side estimates are modeling in for next year. Sell side estimates have actually increased 6% over the last few months for calendar 23. Yet the price to earnings multiple has contracted almost 40%. And that really reflects investors who are quite nervous, quite concerned about the fact that we are potentially late in the semiconductor cycle. And if demand starts to slow down because of inflation or higher interest rates, that we could be in an overcapacity situation maybe in 2023 or down the road. And I think that's what's been pressuring the shares of late.
Well, speaking of that, how are inventories looking?
So it's an interesting story. I think you have to get behind the hood a little bit. Finished goods inventory at the internal chip companies is actually reducing. It's declining. We are seeing some signs of increase in inventory in things like work in progress or raw materials as they set up to make new chips and accommodate for new production down the road. But the finished goods inventory and internal inventory for chip companies is being sold. Whatever is being built is being sold and is being consumed by the consumer. And so inventory levels, whether it's at the chip company, at the distribution channel, is still at very record low levels. And all the companies I talk to who are fabless, who are outsourcing their wafers to foundries, capacity conditions are going to remain tight for until another 12, if not 24 months. I mean, most of the companies are talking about not bringing on new capacity until late 2023, if not further. And so if demand continues to hold up, driven by a lot of these secular growth trends, we talked about edge computing on IoT, cloud infrastructure, high performance computing, then demand is going to outstrip supply for at least another 12 to 24 months. And that dynamic is not at all reflected in the current stock prices or currently reflected in the valuation multiples.
That's interesting. It's a tricky balance, Rajvindra. Yet so many billions and billions of dollars is earmarked in investment that will take, 3 to 4 to 5 years to show up. Do you think that stays in place?
I think that there is a push to build domestic semiconductor manufacturing. Obviously the U.S. Government, the House of Representatives and the Senate, they passed the CHIPS Act, which is a $52 billion act. We're waiting for that to be funded. A big chunk of that money is dedicated and allocated to building manufacturing here in the U.S. So that's a positive in the long term, and it emphasizes the importance of semiconductors to the digital economy. But ramping those fabs is going to take quite some time,
right?
And the capacity conditions are going to remain tight. So
Raj, we're going to leave it there. We're going to have to leave it there, but thank you for the insight, Rajvindra Gill.